and welcome to another Econelastic video with me, Joe.
And me, Andrew.
So the aim of today's video is to teach you about inflation and what are the methods of measuring it.
So if you've watched our previous videos, you'll know that macroeconomic problems stem from the balance between aggregate demand and aggregate supply, where aggregate means total.
So if aggregate demand is too high relative to aggregate supply, then inflation is likely to occur.
Inflation occurs then when there is a general rise in the price levels throughout the entire economy. If aggregate demand increases significantly, firms generally respond by raising their prices, which I'm sure you've all noticed in recent months.
Conversely, if aggregate demand falls significantly, firms will tend to decrease their prices.
What you may not know is that countries actually aim for a relatively low and stable inflation rate of around 2%. This low and stable inflation rate obviously helps businesses make economically sound decisions when it comes to setting their prices, paying wages, and making investment decisions.
So let's take a supermarket, for example. So if you can imagine, all the prices are on the shelves. So if inflation is really high, they'll need to actually change the prices on the shelves more often, which actually leads to more costs because they'll have to have staff to do that.
And keep printing those little price tags off.
Yeah, and this is actually what is known as a menu cost. And you can go and look at that and see what that's all about. But that's essentially just having that cost actually in there of just changing the prices all the time. And so companies don't like that. They don't like that uncertainty of, having to change stuff. So as Andrew mentioned, governments tend to target particular rates of inflation. So the body that actually carries this mandate from the governments out is known as the central bank, which we'll discuss further in subsequent videos. But just briefly, they tend to change the interest rate to try and influence the rate of inflation.
Which we've actually seen as of the recording of this video, which is the 16th of June 2022. The central bank in England, which is called the Bank of England, has actually increased the base rate to 1.25%.
Having said all that, we are actually experiencing higher than 2% inflation right now. And in the past, we've also experienced inflation around 24%, which is due to the oil shocks.
So what does inflation measure? Well, the rate of inflation measures the annual percentage increase in prices. However, inflation does often represent consumer prices rather than prices as a whole. For example, in the UK, we use what's known as the Consumer Price Index, which is actually a basket of goods which are generally seen as necessary to the average household.
And this basket does change on a month-to-month basis, depending on what they think that the average consumer is buying at the time.
So we've actually put a graph on your screen now, which is known as the CPIH, which is the Consumer Price Index, but actually more comprehensive with the addition of associated costs of housing. So it just makes a more comprehensive look of the inflationary environment that we're in. So you'll notice from the graph that from around Q1 2020 to Q1 2021, the government in the UK is sitting nicely just underneath its target of 2% inflation. But then you can see as we move into Q2 2021 that the effects of COVID start pushing inflation up.
So if we look at the bottom of the graph first, and we notice that they're all color-coded, and I'm going to highlight the lilac color, which is the housing and household services. And the reason why I want to highlight this is because, as we can see, the highest number on this graph so far is April 2022. And so it increased from the previous month. And the biggest contributor to this increase is housing and household services. Now, this includes energy bills and basically the costs associated with running a house. And we all know the energy prices have gone up massively. So you can see that actually play out in this graph.
The other colour to take note of is that turquoise colour, which is transport. And this is made up quite largely of motor fuels, or petrol and diesel. And you can see towards the left, the start of this small graph, that there's actually a downward inflationary pressure, there's deflation in oil prices or transport costs at the start of this series, which corresponds to the start of the pandemic. And this is because people were staying indoors, they weren't driving, there was an extremely low demand for those fuels. And then you can see as the graph moves on, that turquoise colour gets a little bit larger, and therefore its contribution to inflation has become larger.
So Andrew's just pointed out that transport had very little impact on inflation. But now, as you can start to see on the graph, as we move away from there and get towards closer to April 2022, that the inflation rate for transport, which includes second-hand cars and petrols, starts to increase and is a bigger contributor to inflation. Instead of CPI, however, we can use a broader measure of inflation.
One that measures the rate at which the prices of all domestically produced goods and services change.
So this is known as the GDP deflator, which we've actually covered in another video, which is in the link below.
We're now going to look at a table which will be on your screen now. This table actually shows inflation rates for several nations across the last 6 decades or so.
So as you can see from the table, the differences in inflation have reduced in recent years. So up until 2019. So we look at the start of the data, 1961 to 1970, and you can see the overall inflation rate has not only gone down, but also converged by country. So it's got very similar per country.
One of the reasons for this are reduced barriers to international trade, i.e. lower taxes.
And also capital movements, so more investment in different countries and stock markets. The reason why these two examples have decreased the inflation rate is because obviously it makes it easier for countries to trade. So therefore, demand and supply are more easily met.
Also, with more countries aiming for around that 2% inflation mark, they adjust their macroeconomic policy to try and achieve this rate. When you next hear inflation mentioned on the TV or the radio, you should hopefully now have a better idea of what it means and how it's measured.
Thanks for watching our Econelastic videos. Please check out our other YouTube videos on a range of economic topics. Don't forget to like and subscribe to the channel.
Please also check out our website at econelastic.com. The link will be in the description for you. This is where you'll find our step-by-step dissertation writing guide, which is suitable not just for economics, but for a whole host of degree subjects. And it's where you can also book us personally for 2-to-1 tutoring sessions.
See you in the next video.